On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Hi team, hope you're all well. That's another week down. It was another volatile one, lots of ups and downs, or downs and ups, you might say. Let's talk through all of that and run through some of the key releases. Then we'll turn our attention to what you need to keep an eye on in the week ahead. Right, global share markets. After a very volatile start to the week on Monday, it was a rough day on Monday. We saw US shares fall 3%, and we saw the Japanese market slump more than 12% just in that one day. But we did see a rebound over the rest of the week, and that made the weekly returns look a little bit more respectable. So the S&P 500 in the United States was pretty much unchanged over the course of the week. It's now 5.7% down from last month's peak at one point, or as of Monday's close, it was down 8.5% from its peak. The high-flying Magnificent Seven has continued to dominate the weakness. That group of stocks are 14.1% down from their peak, while the rest of the market, the other 493 stocks, are down just 3.1%. In the UK, the FTSE 100 was little moved over the course of last week. European shares actually rose. They were up 0.5%, and emerging market equities gained 0.2% too. If you're interested in emerging markets and want to hear more about how that part of the market is going, where it might go from here, I did do an interview with a very good fund manager from the UK focusing on emerging market equities. So keep an eye out for that one, or talk to your advisor if you want to know how to find it. The Japanese Topics Index, it ended the week down 2.1%, and it's now 15.2% off its highs. At the end of Monday, it was 24% below its July peak. So that rebound has seen the Japanese market lift from those lows, but it's still down from the peaks that we saw last month. Equity markets in Australia and New Zealand have slipped in line with some of those global moves. However, the volatility has been much more modest. So the ASX 200 fell 2.1% and the local NZX 50 fell 1.7%. Turning to interest rates, US interest rates were up slightly. The 10-year Treasury yield ended the week at 3.9, up slightly from 3.8. It did fall to the lowest levels in more than a year at one point early in the week, but finished up slightly. And here in New Zealand, wholesale interest rates were also volatile, but the 5-year swap rate finished the week almost exactly where it started, at 3.8%. That's the lowest we've seen in 2 years. New Zealand fixed income rose last week again, so that's just a reminder that if you do want to hedge your bets and cover your bases during these periods of volatility, you often do see risk aversion take hold. That can mean that interest rates will often fall, and that tends to see fixed income rise. So for people that have got diversified portfolios with shares, New Zealand shares and international shares, but also fixed income, they have seen some things go up in their portfolio and other things go down. So they've probably come out somewhere in the middle. If you're wanting a bit more detail about all of this volatility we're seeing across financial markets, where it's come from, what people are worried about, and where things might go from here, I did record an episode last week drilling down into some of the things that markets are thinking about and why we've seen some of the moves that we have, as well as a few thoughts on how you can approach the outlook and the future if you're nervous and you're wanting to de-risk your portfolio. So go back and take a look at that one. You might find it useful. All right, let's turn our attention to some of the key releases from last week. And there was quite a bit here on the local front. Dairy prices rose again, so that was the second increase in a row. The headline Global Dairy Trade Index up 0.6%. That's good because a couple of auctions ago we saw a pretty hefty fall, the biggest we'd seen since August last year, in fact. So now we've strung together two positive auctions, and the headline index is about 6% higher so far in 2024. We've also seen the Kiwi dollar move in our favour too, because we've seen it fall back against the US dollar. And dairy prices are priced in US dollars, so if you see the Kiwi dollar come down, that is a positive from the perspective of farm gate returns. We had New Zealand unemployment figures out last week, and this was the highlight for financial markets, or it's the last key piece of information that we were waiting for between the big Reserve Bank decision that is due this week. We'll talk about that shortly, but the June quarter labour force report, a little better than markets had been expecting, which is good news. And that did bring into question whether we will see an early rate cut from the Reserve Bank. But good to see unemployment not going up too quickly. It still rose. The unemployment rate increased from 4.3% to 4.6%. So that's bang in line with Reserve Bank forecasts. They gave us their last set of forecasts in May, and they were expecting it to rise to 4.6, which it did. But that is slightly below what the economists out there were expecting. Because we've seen a string of weak economic indicators since those Reserve Bank forecasts were done, the economists have had the luxury of rejigging their numbers, and they've rejigged them to the point where they were seeing unemployment rising even further because things have been weaker than expected in recent months. So the economists were picking 4.7, but it ended up coming in at 4.6. So that is good news. However, still the highest we've seen since March 2021, so more than 3 years ago. So it is well off those lows. I think the low was 3.2% in 2022, and that was the lowest we'd seen since the 1980s. So we've lifted quite a bit from 3.2 to 4.6. However, when you look at the 25-year average, it's 4.9. So we're still a little bit below that long-term or that 25-year average. However, and this was the same with the US labour force report that we talked about a week ago, the rise that you've seen in unemployment is not simply because of weaker demand, it's also because immigration has been increasing. So the supply of labour has increased, and the participation rate is also higher as workers re-enter the labour force. Either they've been forced to because of cost of living pressures, so another parent has had to come out to work, or people have had to get second jobs, or maybe because you've seen increased opportunities since the pandemic. You had a labour shortage, and that led to much stronger wage growth we've seen. So some people might have been drawn back in because there was good opportunities and good demand and higher wages. So there's two sides to that story. There's two things that can make unemployment rise. One is weaker demand. The other is increasing supply. And in New Zealand and in the US, it has been a mixture of both. So it is not all completely bad news. We also had the Reserve Bank of New Zealand's latest survey of expectations last week. And this is a quarterly survey. It's not as relevant as it used to be, but it is still something that the Reserve Bank watches closely. And this one would have provided some additional comfort to policymakers. The mean one-year forward inflation expectation fell from 2.7% to 2.4%. The two-year forward forecast declined from 2.3 to 2.03. That's the lowest in about 3 years. And longer-term inflation expectations slipped as well. 5 years ahead, 10 years ahead, they fell to 2.1 and 2.0. So very close to the midpoint of the Reserve Bank's target range there. And that will give them some comfort that the investment community at least has a lot of faith in their ability and their resolve to get inflation back to that 2% target. So that's good news heading into this week's meeting. The key release on the central bank front last week was the RBA meeting, the Reserve Bank of Australia, and it elected to leave its cash rate unchanged at 4.35%. That's still the highest since 2011. Now, a month or two back, there was some speculation that the RBA might need to hike interest rates again at this time, But there was some comforting inflation figures that came out the week before last. We saw the quarterly CPI come in a little softer than expected, both on a quarterly basis and on an annual basis. So the RBA did have the luxury of sitting tight. I do think they will probably wait a little longer than other central banks before they start cutting rates. They're certainly not as close to rate cuts as the New Zealand Central Bank is, or the US Central Bank, and we're obviously already seeing cuts in the UK and Europe. So the RBA will be one of those central banks that waits a little bit longer and holds interest rates at current levels. But with a bit of luck, they're at the top two, and the next move will be down. Right, turning to the week ahead. And here in New Zealand, it will be all about the Reserve Bank. We will get the latest official cash rate, the OCR decision, at 2 p.m. on Wednesday, and that will be accompanied by a new monetary policy statement. That's a new forecast set. And then you'll get a press conference with Governor Adrian Orr and some of his colleagues at 3 o'clock. Now, the Reserve Bank has held the OCR unchanged at 5.5% since May last year. So it's been at that level for more than a year. That's the highest we've seen since 2008. And the last monetary policy statement, which came in May, suggested that that won't change until next year. No cuts in the OCR until next year. That's what the RBNZ has been suggesting. However, things have really changed since then. Since May, we've seen the economy slow more sharply than expected. We've seen inflation fall more than expected. And all of those forward indicators tell us that that will continue. So markets see a 70% chance that you might get an OCR cut this week, and almost 1% of cuts are priced in before the end of this year. So in the eyes of financial markets, you could have an OCR at the end of the year of 4.5 or 4.75, which would be a big change from where we're at today. Now, most of the economists out there don't expect a cut this week. A lot of them believe that the Reserve Bank might wait until October or November. So they see this week as more about the setup. So they are expecting that forecast pack to really prep us for OCR cuts starting in October. But who knows? They might choose to move this week. Personally, I think they should. I think a proactive move is what is needed. And when I consider the fact that at 5.5%, you're well above the neutral rate is probably in that 3.5 to 4% zone. One cut would still leave you in restrictive territory. So to me, it's the right time to begin, especially when you consider the fact that it does take quite a while for increases or decreases in the OCR to work their way through the economy. So I think the time is right, but whether they do or not, it'll be a very interesting meeting, and I expect you'll see a market reaction. So that is absolutely the highlight, Wednesday, 2 p.m. Something else to keep an eye out for on the local front this week will be a fresh housing market report from the Real Estate Institute. Covering the month of July, I'm expecting this to be out on Wednesday, maybe Thursday morning. They usually come out at about 9 a.m. Last month's release reflected ongoing weakness across the market, but it will be interesting to see if some of this talk and speculation about OCR cuts, as well as some initial declines in mortgage rates, whether that's had a positive impact on sentiment and activity at all. So keep an eye out for that housing market report. Those are really the key releases here in New Zealand, but internationally there are a few other things we need to keep an eye on, and the key one in the US will probably be the latest inflation figures. Markets will be awaiting that consumer price index report for July. This is out on Wednesday in the US, and we'll get the producer price index a day earlier. We've seen encouraging trends lately in the US when it comes to inflation, so we're hoping that that will continue. For this month, markets are expecting the headline and the core CPI to increase 0.2% on a monthly basis. In terms of the annual inflation rates, that would see headline inflation unchanged at 3%. That's the lowest since March 2021, same as we saw in June. The core CPI is expected to moderate to 3.2%. That will be the lowest we've seen since April 2021, so a little more than 3 years ago. We've also got retail sales out in the United States. That will be on Thursday. Always important. The consumer is such a big part of the US economy, so that will be closely watched. And over in China, we have got monthly activity indicators on Thursday afternoon. Fixed asset investment, industrial production, retail sales. So we'll get some good updates on the state of play in the Chinese economy. In the UK, there are a few things that we need to keep an eye on as well. We will get labour market data, we'll get some new inflation figures, and we'll get monthly GDP. On the corporate front, there's a bit to keep an eye on. The New Zealand reporting season will start pretty slowly. I would have thought more companies would be reporting this week, but as it turns out, they have all decided to report later in August. So next week and the following week will be the two really busy ones. There's, for some reason, no one really reporting this week outside of Skellerup. Across the Tasman, there's quite a bit more happening. Lots of companies reporting results. JB Hi-Fi, CSL, Seek, Computershare, Cochlear, Goodman Group, Telstra, Amcor, all of those businesses announcing results over the course of this week. And internationally, while the reporting season is sort of winding up, most companies have already announced their quarterly results. Still a few things to keep an eye on. Still on that retail theme, in the United States, we'll have results from Home Depot and Walmart, and a couple of those big Chinese tech giants also announcing results. Tencent on Wednesday and Alibaba on Thursday. So there you go. That's how the week is shaping up. Hopefully some of that is useful. Hopefully that helps you navigate your way through financial markets in what could be another up and down week. I don't know if we've seen the end of this volatility. My suspicion is that there might be still a few bumps in the road to come over the next little while. So keep an eye out for that Reserve Bank decision on Wednesday afternoon. That will be really interesting to watch, and let's cross our fingers that they take a proactive approach and choose to do the right thing on Wednesday. All right, thanks for listening, team. We'll talk again soon.
For more insights, visit craigsip.com.